Welcome everybody to this edition in person and virtually of the DBRS Morningstar US Frontline Perspectives in RMBS. Obviously, we're going to be talking about reverse mortgage securitizations. And I think it's probably appropriate to start off with a reverse mortgage joke, but I've never heard one. So we're going to skip that and let's get right into it. So the reverse mortgage market obviously has grown quite a bit over the past couple of years, especially during the kind of post-COVID or mid-COVID crisis. And we've seen a lot of securitization activity, a lot of advancements, both on the government side and the private side. And so it seems like only yesterday, you started with the HECM program back in the, I want to say it was the 1960s, 1970s, officially became a program in the late 90s, I believe, after being a pilot program. So then we branched off into the kind of the private loan segment, and that really grew as well. So we're at an interesting junction now where the market is a lot more mature than it was before. Went through now the second crisis in the mortgage market. And so I think we can start off by talking about what does the landscape look like for reverse mortgages and reverse mortgage securitization today? And so, things like who are the lenders? What do the lending products look like? What are the financing options? So I think, from that standpoint, we can start off, perhaps Derek, if you want to go through what that landscape looks like in today's environment, kind of where we've been from then.
Okay, so this is an off-the-cuff discussion, but we've actually planned our lines pretty carefully, so I'll launch into it, right? So I used some sort of speech props with the handouts that I've gotten. So the first few pages I'll speak to on occasion. And the first page here, the top right, shows the issuer HECM league tables. So just who the active people are in the industry. And the bottom shows a HECM issuance chart, which we track about close to 60 billion since the program started since 2008, which is when I'm showing the data from. So 60 billion is about the size of the market. The private label market is about half of that. So, that's kind of where we're at with all that side of the market, right? And the second page, I'll try not to do too much off these props here, but it shows kind of like what we are rating versus, the HECM stuff, which is almost a billion. We don't know how much private label stuff has been done because about half the market is actually what's called privately rated. So if you're not on the deal somehow, you just don't get to see it. So it's almost like dark matter, or like half of the iceberg is not shown to the rest of the universe, right? So we've rated about $20 billion in loans and bonds, about $40 billion worth of homes are currently being rated by us. So, if someone says, what's the size of the market out there? I don't really know, but that's about it. And, Rich was kind enough to say, I think we rate the bulk of the deals that are out there these days. So we don't have them all, but that's got to be around the order of magnitude of that lot, right? So, and just to sort of finish off that, it's hard talking to people who, some of them don't know reverses very well, and some are amongst the most knowledgeable people in the industry. I see some people I know here that know a lot more about it than almost anyone else. But we kind of partition our universe into two flavors, the one of which is the private label securitizations, which is for proprietary reverse mortgages, meaning that they are typically larger homes and they cannot go into the HECM product, which is the government insured product, which is capped out at a certain loan threshold. So the smaller homes tend to go into the HECM product, and the larger jumbo stuff goes to the private label product, right? And then thirdly is a spin-off, and I'll keep quiet after this, I guess, give you the time warning, but it's after loans have been in these HECM government insured pools for a while, they can be bought out, and Stephen's firm and G's firm and the help of Morgan a lot re-securitize these loans that were government guaranteed. They're still government guaranteed, but they're being pulled out of the Ginny transactions and being reissued privately. And that's probably enough for me for now. So
terrific. Yeah. And speaking of, I guess, loan products, we do have someone from reverse mortgage funding too. What type of loan products, for instance, does reverse mortgage funding offer?
Sure. So we have HECM, which are the insured products. They're FHA, regulation reliant. They have the PLF tables that are set by FHA. And we have the proprietary product, which is I'll call it a more malleable product, which is not governed by FHA, which allows borrowers to tap into their home equity for a larger amount. We do up to 4 million. And there's no upfront MIP, which is required in the HECM. So there's the advantage of that, lower closing costs, higher PLFs. And we also—
MIP is mortgage insurance premium.
Yeah, mortgage insurance premium that's required for the HECM product upfront, 2%, which is, can add up for closing costs. And the ages for the proprietary products is lower. Ours goes down to 55 in the states that it's allowed. So there's that flexibility as well.
Oh, terrific.
What's the relative mix between what's happening, what's being originated right now, non-agency versus agency?
So right now it's about like 30, 35, 65. But I think, and you guys tell me if I'm wrong, but I think we're seeing more concentration going to the prop. I think the borrowers are moving towards a more a sophisticated borrower, not the cash needed, cash strapped borrower, and they have bigger homes, they have more value in the home. It's HPA is so strong, and they're very cost savvy about the upfront MIP. So I see the concentration moving more towards proprietary side.
When you said 35, 65, it's 35 prop, 65 HECM. Yeah. And I think somebody in the room told me that, the market is bifurcating. I think you sent me some materials on this where historically it was more targeted to people, or thought of as being an asset class for people who are kind of cash strapped. So they're a house rich but cash poor. And that paradigm is changing right now because that still exists, but now there's a lot more people who don't really need the cash up front are taking out HECMs or as a sort of portfolio management and future line of credit tool. So they have a bigger home, they have a big potential line of credit. It's almost like an investment in line of credit because line of credit grows over time. And if you haven't drawn upon it, it's just like an asset in your toolkit you can have. So you're seeing a lot of borrowers like that coming up.
I mean, we're in turbulent times. They don't want to liquidate their portfolio. And we're seeing a lot of people retiring earlier too right now. So that bridges the gap between early retirement and the ideal age to collect your Social Security.
Right.
Terrific. So as you can see, there's a lot of variations these days, especially across government and private. And so let's switch gears a little bit and let's talk about securitization structures. So to the extent that there are certain variations within the loan products themselves, from the securitization market, the term funding for these assets from various different participants, like we have on the panel. Let's start off with who is investing in reverse mortgage securitization paper.
So we started on NationStar's first few deals in 2013 and 2014. I think those were, the first deal was unrated, then Moody's, and Moody's has generally evolved into a DBRS Morningstar only structure. And in the beginning, it was 5 to 8 investors. And now we have 85 investors who have participated in the 4 issuers: Waterfall, RMF, NationStar, and Finance of America. On the non-agency side of things, you have Waterfall in the RM shelf, you have RMF in the RPIT shelf, you have Finance of America, who does the private deals that Derek alluded to, and then you have Putnam in Boston, who utilizes the Bold shelf. And those are the main issuers, and that investor base is more like 25 to 30, call it, accounts. A lot of them are insurance money who are using it as a natural hedge. Depending on the profile of the bond and the rate environment, which has now evolved significantly in the last 6 months, you can have fast money and hedge funds towards the bottom of the stack who are looking at a low to mid double-digit yield return with some leverage.
I interject with you? So my little visual aids that have helped me here on the bottom of page 3 shows that the top issuers that we see that Morgan was describing, right? And I don't really get to know who the investors are, but I do get calls from investment folk, asset managers, but a lot of insurance companies. And so when I'm preparing for this presentation here, I thought it'd be to show a total return chart or an excess return for treasuries as an investment, because when I used to sit in the investor seat, that's paramount. It's like, how did you do versus a comparative treasury? So I called up a couple of the insurance players and I said, give us your total return on your investments. And they said, oh, we don't track that. So that made me fell off my chair. I was like, well, you don't care about the returns, but insurance companies care about different things. So it's sort of funny that to me that they're buying without a total return, frame of mind.
Well, I think they think about it that way.
Yeah.
I think bond funds have generally had low single digits returns in the last few years. Now we're in a rising rate environment that'll change. So I think based on AAAs that were at 45 basis points in the tight end of things, and now they're at 140 basis points or 165 basis points. So I think there is still the ability to generate a return that beats an index.
Yeah. Are they outperforming? Are the private labels outperforming the Ginny Heckham offerings?
The structures are very different. So we can. I don't want to talk too much about this because I'm just the banker and nobody wants to hear from the banker. But like if you were to distill everything down into a couple sentences, that the Heckham agency side of things is generally tranched 6 or 7 classes. You're issuing a AAA that's, call it 70 to 75% of UPB, all the way down to 100, sometimes more than 100 of UPB. RMF just priced the deal earlier this week. They sold to 103.45 of UPB. So you have negative CE on one of the bonds. The non-agency or prop side of things does a very different structure where you're setting the coupon on all classes generally to the same coupon, although there are some examples where that's not true. And you have negative CE on your AAA. And effectively, it's newly originated collateral that has a 2-month weighted average loan age, and you're relying on the collateral to accrete at 6 or 7% a year versus almost no severity and a bond coupon of, call it 2.5% a year. And then that difference, that excess spread that's trapped in the structure, will materialize over time and collateralize your bonds over time. So there's always this point in the future, and prepays affect this, which I'm sure we'll get to, but there's always this point in the future where the collateral balance for the first time exceeds your bond balance as your bonds are paying down.
Worth mentioning, I guess, on the Waterfall side, we've also issued a number of transactions which feature prop product, but that's kind of pre-crisis or early teens origination as well, that has a little bit of a different profile, where you've had more seasoning, you've had kind of performance on the assets, the LTVs have creeped up a little bit, but still you can have a very kind of concrete expectation of cash flows over time.
Speaking of, now that we're on the topic of structure, and this is for the panel, any unique structural features, especially when it relates to things like you can kind of parallel to the broader RMBS market, amortizing bonds, like triggers, tests, thresholds, events of default, the allocation of losses, so on and so forth. Anyone want to go specifically into, what's the risk reward within the structure for investors, and across product types too? It could be seasoned versus newer, or where things are going, and then either Heckham versus prop, season versus new, so on and so forth, so that we can get a kind of a good view of what that structural nuance looks like across the space.
So we recently started putting a CPR trigger in our prop deals. And so if CPR hits a certain trigger level, we have to inject cash into the deal or collateral. And that's been because of the refi environment that we're in. So I think we're always trying to innovate the structure to meet the inquiries and the demands of the investors. And that was one of them. Our last RPIT deal, our subs started doing current pay instead of the normal accrual. We're constantly evolving. I don't know if you guys have seen anything else.
I think the biggest protection on the HECM side of things, on the buyout side of things, is the subordination of servicing advances. The servicer has true cash out obligations in the deal, right? They have to pay the mortgage insurance premium to the FHA, and they have to pay for foreclosure and legal costs. And although those things accrete on the loan balance, they're actually cash out. They actually have to pay those things. So the servicer is advancing into the deal. And as more and more loans go through the foreclosure process, that can become a significant monetary outlay. And all of those advances are subordinated until the most junior bond pays off. So from a servicing alignment perspective, you have a servicer who is paying attention and advancing into the deal, but also you can re-securitize based on the stepped up UPB balance. So there's a strong incentive to ensure that the deal performs, and when it becomes time to, there's a lockout mechanic, but when it becomes time to, you can collapse the deal and re-securitize.
Subservicing fees as well. So subservicing fees you have to pay out to, as the issuer, and even as for us, the servicer is typically Mortgage Assets Management, which is a company that we own. MAM is set up to oversee the subservicers who are doing kind of a lot of the work, the arms and legs of actually reaching out to borrowers, making collections, going through the foreclosure process. And so the subservicers, predominantly PHH and C-Link these days, they're still accepting their fees on a monthly basis from the servicers and the issuers. We don't get to recoup that from the top of the deal, subject to a small kind of $50 cap per loan. But we do get to recoup that sort of at the end once the deal is called. So further incentive for us to let the deals actually play out the way that investors expect them to, and to call them by the point when they're callable.
Yeah, strong incentive to call within, let's say, 5 years, potentially, right? So we're seeing quite a few of our deals starting to, churn over like that, which is obviously good. You get the money back, right? So
with that, how does the interplay between, let's say, an optional issue or call versus, basically, how do you manage, or how should markets look at the maturity? What does that look like, given, I guess, the newer structures?
I think in most of the deals, you have a mandatory call date, typically at 5 years or so, 5 or 6 years. I think our practice is like that, where you have to start an auction procedure. If the notes aren't paid off at 5 or 6 years, you'll have an EOD. You start an auction procedure if the notes aren't paid off, and if the auction fails, there's a procedure just to keep the auction going again and again. So you have a successful auction.
And I think it's a delicate balance before that based on the prevailing interest rate environment. Like if you were Waterfall and you did your assignable buyout deal, like your cost of funds is 2%. It's right inside 2%. If you were to collapse that, and you can't because the mechanic's 36 months, but if you were to collapse that and re-securitize, I don't know that the new deal would cost 2%. So it's this healthy balance of monetizing these trapped funds that we've discussed, but also what are you refinancing into? What does that interest cost look like?
Until you get to the mandatory funds, in which case we don't have a choice, and somewhat driven by investor demand in the market, somewhat driven by tax considerations. Most of these deals, both across prop and HECM, have mandatory call dates either by class or for the entire deal.
And you'll have a lockout, so the optional redemption won't happen until a year, usually a year out. So you have a year of protection.
it's also worth noting the ratings agency doesn't give credit for the buyouts. For the auctions, they assume the auctions will fail, and the mandatory redemptions also fail. So we typically rate till the exhaustion of all the assets. They have to pay off the deal by themselves without any help. But we're seeing in practicality the calls are being exercised. All the issues that you call in the deals in time.
Now, sticking inside the structure, as far as enhancements, to the extent that, as we know, reverse mortgages pay a lot differently from normal amortizing mortgages. So the cash flow event, it's a one-time event to get your cash flow to the structure. So internally, talk about things like reserves, or how does that get funded, till you have a cash flow resolution event with the loans. and how that may or may not be different across different structures.
Derek, if you want me to jump in, I can.
Yeah, go ahead. This is your section.
Yeah. I'm prepared for that. Yeah, I think for reserves, Derek and I, when we're reviewing documents, we typically look to see what the deposits are for the various reserves, future funding, reserve accounts, and servicing advances, and so on. We'll check what those are. To make sure that your models you're comfortable with it for your modeling perspectives. So that's the first one, is the closing date deposits that come from the note proceeds. Typically in the waterfall, either before or after the payment of interest, you'll have a top off of the reserve accounts, the various reserve accounts. And I guess I think one of the things we had talked about, and I think in some of the CFMT deals, you have responsible parties who have to backstop certain of the obligations, like servicing advances. And the servicers every now and then will make advances out of their own pockets. But I think in the past, we had seen earlier deals with VFN notes or variable funding notes that were used to fund these things on the side, but I don't think we've seen those recently.
No, the two earliest waterfall deals we did had the VFMs, but we haven't seen them.
Yeah, and that was mostly driven by a very sort of steep variable funding component on the loans themselves. So there was a lot of open draw, and we thought, best to give protection to the deal in the sense that, if 10 years from now, a borrower on the pool still wants to draw some LOC that he has outstanding, to make sure that there's capital there for that borrower to get their funds at the end of the day. I think what we've also seen since those deals is that those VFNs have rarely, if ever, been tapped. And so, the kind of punchline is the LOC draws have been an extremely predictable, sort of, 1 to 2% a month. And it doesn't deviate even during crisis periods. I know NewView publishes their kind of draw database, and that's been something that even through the COVID period, we were watching that closely to see if there would be any idiosyncratic activity, and really there was none to report. So
And
frame thought going forward.
And the draws are an unpredictable thing. So you get some loans that don't have any draw component, and some that offer, up to a substantial balance at the loan level for draws. And some of the early deals we saw, and this is something I wanted to sort of probe Seth about in terms of his vantage point in observing how the underwrite, the basic deals being constructed differently over time. But sometimes you'd have 2% potential draw on aggregate for the deal. So the issue could then say, all right, well, these borrowers can take this money, and when they take a draw, who pays for it? And so the issuer could pay for it out of pocket, or put it all into a fund, sort of pre-funded. So just sitting there ready to be used, which benefits the deal because there's 2% extra money in the deal. But we've seen more recently some deals that have had 50% extra draw. So if you had a $500 million deal, it could be $250 million locked in an account, waiting for someone to draw it, which is uneconomical. So then the question is how to deal with that, right? So you could get a VFN to potentially fund that stuff, or you could make the structure pay its own way, so that when some loans are paying off and some of that money gets used to fund someone else's draw, the question is, do you have enough? You see. The other point we touched on at the beginning, and this is fundamentals to reverses, is that these things pay in a sort of unitary fashion at the end, right? So it's just like no payments, and suddenly a big payment of accrual at the end. So the question for a transaction is, what if the no payments come in over a period of time? How do you pay current interest, right? So many of these transactions have, maybe 4 months worth of interest or 8 months of interest reserve accounts. And so then all you need to have is one loan pay off for the next 8 months, and you can replenish your funds, So, but I'm sure these things have, evolved since the early deals, So I think to see what you thought about the things that have been developed over time, at least from what I've seen, structures got much more complicated over the last few years.
Yeah, absolutely. I think the deals are constantly changing. You and I have reviewed dozens of deals together. you have new issuers coming into the space, and lawyers never draft documents anew. So they're borrowing from other structures, presumably, but they're they're using the same technology that's already out there. And I think, as we were talking about earlier, I think your deal structure is going to change based on issuer, based on the type of collateral you have. Are they HECMs? Are they props? Are they performing or not? So I think really the docs have, I think, overall gotten more complicated, I would say. I think the waterfalls have gotten more complicated. I think there are more steps. And I think it probably makes it harder to model. when you and I are going through the docs, I mean, it takes us quite a bit of time to go through the waterfalls and,
a lot of moving parts.
Yeah, a lot of moving parts.
Is there anything sort of unique to reverse? I just have a reverse hat on these days, whereas you see the whole purview, right? So maybe interest reserve account or something like that.
Yeah, and I think that these are, like you were saying, lumpy assets. They're paying off in full, so you're getting chunks of money at a time. So you need to have the interest reserves that you and I always look at for all the deals. Is it 3 months, 4 months of interest? You're expecting some payoffs that could be used for that as well. But yeah, interest reserves are definitely a key feature. The future disbursement accounts you and I look at closely for all the deals. Whether you're funding lines of credit or the different future disbursements that are required to pay through.
Yeah.
How about while we're on the topic of, obviously there's a great operational and financial responsibility of the sponsor / servicer. How about events of default and how that's accommodated or protected within the structures, again, either financially or operationally?
Yeah, for events of default, I can speak to that one. It's like most securitizations, those notes that are current pay, if there's a failure, monetary failure to pay interest, that's an EOD. A unique feature of these deals is that there are accrual notes, which we spoke about a little bit earlier. So basically the interest on each payment date is capitalized, it's deferred, capitalized, increases the principal balance of those accrual notes, which are typically below the A1, A2. So the accrual, non-accrual. So if you couldn't have an EOD for non-payment on an accrual note. The other thing you have with the A1s typically is their note rate is the lesser of a fixed rate, say 2%, and available funds at that step in the waterfall. So it's protective of the deal in the sense that you could have less than the required, say 2% fixed rate to pay. So you only have interest to pay 1.5%. Then you have a cap carryover of 0.5%. In some deals, not all of them, I'd say maybe a minority of the deals, if that cap carryover isn't paid in a year's time, that can result in an EOD. The natural mandatory call date that we were talking about, or the stated final maturity date, if you don't pay everything, all the note obligations, just like any other deal, those become EODs. Typically, you'll have covenant defaults and bankruptcy, insolvency event defaults, which is just like any other securitization.
I think the big difference between the HECM side of thing and the non-agency side of things is that on the HECM side, you have a mandatory call date or a stated final, however you want to think about it, that varies typically based on tranche. That's not always true. Some structures just have a 5-year mandatory call date. Some structures have time tranching, right? So if your A bond is like a 1 to 21 payment window or something, your M1 might start in month 24 and go to month 28. And then if you don't, so that 24 to 28 is 5 months, right? And you're taking your M1 principal balance. If it was $10 million, you're getting $2 million in those 5 periods. If you don't get $2 million and your bond doesn't pay off by the end of that period, it's an event of default, which is a very big difference than in non-agency land, which might have a 30-year legal final. And you do the auction thing starting at year 5 or year 6, but it's not an event of default until year 30. So I think it is important to kind of distinguish between what's happening on one side of things versus the HECM side of things, which might be a little tighter in this particular example.
So we've been talking a lot about, obviously, the domestic market. Anyone want to comment on versus overseas at all?
Yeah,
That
so
might be different or the same.
yeah, I mean, I was hoping other people might know more because I focus on the US, but I'm aware that there's a market in the UK that I believe started before the US market started out. I know that DBRS is rated reverses out of Canada, and I know our colleagues at Breen gave us a pool of Canadian reverses for one time to look at. So those are up there. Our team, our European DBRS team, has been telling us like there's some stuff up in the Netherlands which they've been looking at, and they've also said that there's some Australian reverses that are going on. I don't think there's very much volume really out there. I think the US is doing most of the volume, at least in terms of securitization, and that's really as much as I know. So it's not links to anyone else's non-US. No, nothing in Bermuda.
All right, we'll stick to the US.
Okay.
Switching gears a little bit, I know we talked quite a bit about structure. Why don't we move on to performance? And so obviously collateral performance drives structural performance, and there's been differentiation in some cases, but the markets have been certainly unique and one directional as far as housing and credit performance the past couple of years in the COVID era. How about, why don't we start off with, what are the key differences, or what are the risk factors that the market should obviously be aware of related to the difference between fully amortizing mortgages versus, and then how are they, for instance, how are they underwritten? It's a FICO based, it's a DTI based, like the traditional mortgage, or what are those factors that are underwritten to, and then what do those risks present that folks should be aware of?
So the underwriting is different because reverse obviously doesn't have monthly P&I. So it's just trying to do a test of whether they can maintain their taxes and insurance and maintain the home. So it's far less stringent for the underwriting criteria. It's much more heavily focused on valuation. So for us, anything over 2 million, you get 2 FHA appraisals, FHA form appraisals. Between 1.5 and 2, you get an appraisal and what's called a VRR, which is like a verification of the appraisal. It's a review of the appraisal, which is very in-depth. And then anything below that, you get an AVM and a full appraisal. So it's much more focused on the value of the home, because that's really what you can get at the end of the day, get back. It's a non-recourse loan. So it's less on how much the borrower makes every month and more on the value of the home, and just to test if they can maintain the TNI and maintain that. That's the underwriting guidelines side.
So from the agency's perspective, we look at most of these things, but we get given FICO, but we don't have any data that show that behavior of the borrowers are related to FICO in any fashion. We internally are undergoing an entire sector review this year, and so I'm sure someone's going to say, where's the data on FICO? So if anyone has any FICO related data, then I'm curious. We've been storing it until somebody proves there's something, but I'm not aware of that. I mean, obviously, it's a mortality table driven product, so it's driven by people's death profiles. So that's a strong relationship. That's the other stuff is not clear. We talk a lot about defaults in the space, and one of my slides that I'm not going to page to define, but it's like the defaults are very minimal in the space in general, right? And my perspective is that pre-credit crisis, the product set was evolving, and there were some sort of wrinkles that have been solved now. So, back in the day, the product took a sort of reputational hit because one of the borrowers died, and then you kicked Granny out the house because Granny wasn't on the loan. So they said, okay, you need to write both the borrowers, both the occupants on the loan so that they can stay there for a long time. So that was one of the kinks they fixed. And the other one was that the borrowers were sometimes just forgetting to pay their tax and insurance. So my understanding is that they, at the loan level, they set aside an amount to pay the tax and insurance, they escrow it so they can pay. So the senior, without being patronizing, doesn't forget to pay their tax and insurance, and in which case they go through a default. So you kind of finesse or obviate the default event. So you can't default if someone else is paying the thing for you, because so they basically reduce defaults by simply just removing the modes of how defaults even happen in the first place. So, my understanding is the defaults are pretty much less than 1%, 1 CDR, is what I see in the data. So it's pretty low.
I would add also the borrower counseling component. So since
Right.
you have an obviously aging cohort of borrowers, you want to make sure that these borrowers are all fully understand what product they're getting. And we at Waterfall certainly think that there's a lot of benefit to a reverse mortgage for a borrower over 62 or over 55 in kind of the proprietary space. But you need to make sure that the borrower fully understands kind of the ins and outs, and really, a lot of the stuff we're talking about up here, make sure that they understand that, not necessarily on the securitization side, but on the actual loan level side. And so I think post-crisis, one of the positive developments in this industry is that focus on borrower counseling upfront as part of the underwriting process.
In terms of performance on the securitization side, I think the HECM deals are generally performing in line with expectations. I think the foreclosure moratorium kind of changed that a little bit at the margin. So maybe some deals are veering a little bit from base case, but I think generally performing in line with expectations. I think on the non-agency side of things, the prop side of things, it's a different story. And a lot of that is fueled by all the HPA that we've seen in the last few years. In periods of very high HPA, you're talking about a loan that has, call it a 6.5 weighted average coupon in your deal. If you have 10 or 11 or 12% HPA, the borrower is getting older, right? So they're at a different point in the PLF table. So they're entitled to more proceeds because they're older, but also now they have equity that they can monetize in their home. So 10, 11, 12% per year for 3 years and 6.5 WAC starts to add up to real money when you're talking about $1.5 million or $2 million home. So all of that is a long-winded, boring way of saying prepays are generally bad when you have an overissuance of bonds and you have negative CE because you have less collateral and you need the collateral to continue to accrete and have that neg am function in order to collateralize your bonds in the future. If your loans continue to prepay, there will be fewer loans to take you out in the future, which is, as G alluded to earlier, a very good reason why we included the CPR trigger, to add more loans, reserve the option.
Right, and that's a big point. So some of the most of the prop stuff is under collateralized. So you have 100 of loans which are backing 110 of issuance. So if they pay you back 100 tomorrow, you're 10 short. So you need to be able to carry at this. Let's say the loans have 6% WAC and the coupon is 2%. You're carrying the 4% a year. So after about 2 years, you've accrued 8%. So you need the collateral to last on average for 2 years to pay off that premium. Once the dial flips and you're no longer at a premium, you basically have more collateral than bonds, then prepayments are fun. You can just get paid off whenever you want to. But it's in that incipient stage, you've got to carry, and this is what these reinvestment language is all about. So if things change too quickly, most of the deals have been reinvesting these days. So that's helpful. I have a chart here, which is on page 4 in your handout, which shows the credit enhancement growth over some time. And I didn't really have a way to slip this in, so I'm going to do it now. But it's pretty much in sort of an up and to the right chart. It's like, I'm just showing it here, but it's basically, this has got a kind of a healthy credit enhancement profile, which means that, when compared with issuance, our universe has been growing credit enhancement, which is good. The rate of growth is different 5 different cohorts in the set. So, on average, the new sort of prop stuff is growing about 5 to 6% credit enhancement growth per annum, which is pretty healthy growth as far as I'm concerned. Some of the hack and buyout stuff is growing a bit slower. The ARBO stuff is buying. Primarily that's because it's assignable, so they are assigning those loans to HUD, replacing them. So they have a revolving period for 2 years. So if you're revolving the collateral for 2 years before you start, you're not really going to grow that much. But it's a pretty happy picture. So I'm putting this together for our own internal sort of reviews. But and again, there's no specific reason to bring it up, but it's interesting to see that nothing speaks louder than success. So I think something's been going right so far. We could probably talk about this in the future, but it's things have done well till now. So
it's somewhat related, but in terms of losses to the deals for the HECM deals, particularly the non-active, I think the biggest, or what people see as one of the biggest risks, is to meet the HUD deadlines. And so we call that, if you don't meet it, it's curtailment. And so that can potentially curtail what you ultimately get from HUD in terms of an insurance payment. But I think it's across the board. We have to make the trust whole for any such losses. So that's, I think, an important point. That could be a source of a big loss.
So that's why the servicing is so important in these deals, and the sub-servicing, and it's just so regulatory driven, at least for the HECMs.
We've talked a lot about how things are different from the traditional mortgage market, and interestingly enough, in the reverse mortgage market, things are reversed. So, sorry, that was a reverse mortgage show.
Finally,
You found it. So, how do you? And this is open to the group. How do you look at things? In other words, I would think off the top of my head, actuarial tables, mortality rates, and then HPA models. Since the focus is so much different on, let's say, monthly debt service. What type of analytical tools do you use, approaches, what are available for the market, investors to look at things on their own? Anyone?
Yeah, so I mean, I think a lot of the things you mentioned, Mark, the benefit in this space is you have a lot less idiosyncratic activity in terms of, will the borrower pay in any given month or not? You are able to, for the most part, attach into kind of very predictable sort of moments of cash flow, and those are based on actuarial tables that have been developed by people way smarter than me, that have a lot of data to kind of show for it and can track that performance. In terms of foreclosure timelines, things like that, also very easily sort of seen in the market, and you can predict kind of how things will develop when things sort of go down the default path. And so, a very predictable sort of product in terms of cash flow. For us, we, on the loan side, have proprietarily built models that we use on the cash flow side. But once we go into securitization, we're using Intex to model up the bond side through underwriters who help us out with that, and then are able to kind of run stress cases and monitor the book over time as we hold the residuals.
We also have a proprietary model that we use, and a lot of the inputs are from our experience in terms of default timelines, our behavior, and on the securitization side, we're using things.
The source of data is a challenge, right? So, I mean, there's a lot of data available from Ginny, basically on the HECM stuff. But you have to kind of scratch the surface sometimes to sort of see what's really going on. So some of the things we try to calibrate to the agency are like reasons for prepayment, right? To see what it should be. So prepayment is sort of broken out into, basic refinancing, morbidity, which means it's the guys moved to a nursing facility because they fell on the stairs or whatever happy thing. And then there's also mobility, which means they're moving to Florida, and two of those are going down with time because your ability to refinance voluntarily and also your mobility. I mean, if you're going to move to Florida, why take out a reverse and then move 10 years later? You might just wait until you go and then get the reverse. Whereas the morbidity is going the other direction. So so these under the hood, different moving parts, and to try and tease those apart are very difficult because, if somebody just sends a check in, they don't really say, well, we did it because we decided to pay it off, or we did it because we're moving. So to try and attribute those, those drivers is a bit hard. At the agency, I have slide 8, which I looked at our entire book, and I think we have a pretty good data set because we have most of the unwritten deals out there. So I have known level information of that stuff. And it's sort of interesting because, a lot of the drivers are obviously mortality, which is people's, the death-driven events. But the main drivers for defaults, which are T&I defaults, basically occupancy defaults and repairs defaults. I tracked almost no repairs defaults at all. It's just completely non-existent. People don't bother to do their repairs. So it was sort of interesting to me that I could really at the loan level track information like that, but it's not really available. I know Review Advisors has information, Green has made it available to me. The issuers have a lot of information. I've been begging information from Stephen, and and I'm probably going to be doing more begging information. But I just say it's a little hard for people not deep in the industry to access factors like that, So do you guys agree, or?
Yeah, certainly, I think even from the issuer seat, like we have access to a lot of our own information on loans we've seen, but there's a lot of market beyond us and in the broader HECM universe, especially. And it would certainly be great if any volunteers out there to kind of have a data tool to aggregate everything. I know in a lot of other sectors, you have like a DV01 or players like that who've, taken public deals and aggregated information. And, to some extent, again, RMI and NewView are aggregating certain information. But, I think as of right now, at least, Intex is kind of still the best tool to use in terms of actually looking at performance. And there, I think it's more focused on the bond side, but certainly something that we'd love to cooperate and help build out if someone's focused on it.
Yeah, I tried to look for these component data inside the Intex, and there just wasn't that level of detail. And see, my problem from the agency perspective, someone's going to ask me how I decided to come up with these numbers, and it's harder to point. So I look at my own data like that, but I'm not aware that Intex had the level of granularity we needed. So it's a challenge, I think, some of the data. It's there, it's just not easy to get to. So.
I know
don't think
we're.
Intex has details, the collateral details.
Yeah, exactly. So, but if anyone knows of a good source, give me a call.
Keep searching. I know we're running close to the end of our session. Why don't we do a little bit of a round robin? Start with Morgan, perhaps. Any thoughts around outlook for the reverse mortgage space, credit structure, participants?
I think we'll continue to try to innovate, continue to try to solve problems for the issuers that we work with. I think it will become an increasingly important tool as the baby boomers age and look to augment retirement income. So I think stay tuned. I think non-agency will continue to grow. As G said, it's becoming more and more larger component of their origination. So I would expect that to grow, and then the HECM side to kind of stay steady state, although Waterfall is doing very interesting things, very large transactions.
Yeah. And it's an exciting and evolving space. 2020, you guys led Deal of the Year transaction, which we rated. That was one of your shelves. So that was a good thing. And then we did a transaction this year that I was excited about. That as a sort of a repeat. Morgan wasn't quite as excited about it, but I thought it was a good candidate. So
I don't know if it was that or there's another candidate that I think is outside of reverse
is
that
particularly worthy.
that is a dark horse.
Yeah.
Let's say that.
But yeah, suffice to say that there's a lot of innovation and creation going on in the industry, right? To the good, right? Yeah.
I would certainly agree. There's a lot of complexity in the space. I think the reason you only had, I think you quoted like 7 or 8 investors in 2015 to now what's grown to probably close to 100 if you're counting the kind of regional bank and credit union sort of investor base that's also attached into a lot of deals being issued. I think it's been a complex space. There's been a lot more education out there and a lot more sort of performance out there for investors to attach into. As that's occurred, for us as an investor in loans and as an issuer, we've gotten more comfort in knowing that the kind of capital markets are out there and sort of interested in this product as well. And so that's kind of led to more investment. But at the whole, I would agree with Morgan. We have a aging demographic in this country. We have home equity that's growing leaps and bounds on a yearly basis. And so a lot more of that home equity is getting trapped in the aging cohort, and really for borrowers now who don't have access to monthly income, who are retired, they need a way to tap into their home equity to have the cash to be able to sort of age in place. And we think, at least so far, the reverse mortgage and kind of the different nooks and crannies are the best sort of solution out there as of yet to be able to tap into that for those borrowers.
I agree.
Sure. I alluded to this earlier, but I think our borrower profile is changing. It's becoming a more strategic borrower, and they're trying to navigate these times right now, which is turbulent. And I do think there is going to be a shift towards more proprietary. I do think there's also a lot of growth in that the perception of a reverse mortgage is still, it's not as positive as it should be. I think there was a New York Times article recently that was put out that profiled some borrowers who took out reverse mortgages. It was a very positive article, which was great. And it profiled borrowers who decided that they did not want to tap into their investment portfolio, which could further grow and potentially tap into an LOC with a reverse. And it was enlightening, and it was just really good for New York Times to put out an article like that. And so I do think there's still a lot of room for a change in perception on the product. I think I just today heard a story that we did a study with a few borrowers or potential borrowers, and we laid out the features of a HELOC and the features of a reverse. But we labeled them as HELOC and reverse. And initially, 75% of the borrowers wanted a HELOC versus a reverse. Then we hid the name, and we said, there was no labeling of the product, and we just laid out the features of what a HELOC has versus a reverse, and it flip-flopped. 75% wanted a reverse. And so when you do like a feature to feature, it's far more flexible. It's a non-recourse loan. It's really what would fit the borrower profile of where we're going. And so it was an interesting study that we did. So I think there's a lot of room for growth there in the industry.
Yeah, I'll sort of tag on to that, because internally we've had some requests for commentary on how something like inflation is going to impact the sector and or rising rates, right? And so, it's top du jour, but it's the thought process is that it shouldn't really on the margins affect production of loans at the moment. Feel free to jump in and disagree, but if you have the two cohorts, the kind of borrowers that need the money, if rates go up a little bit, well, they still kind of need the money. And, if they think ultimately they're going to, die and lose the house and they're underwater, what do they care if they're more in the water, kind of thing. Conversely, the people that are the strategic borrowers that have taken on a line of credit, the line of credit grows as your rates are higher, so your lines of credit are getting actually more attractive to do that game. So I think there's some sort of positive reasons to think the issuance will, at least the loan production will keep going. The flip side, and I forget who told me this, but if the rates go up to 10%, then the spigot will shut off, because the amount you'll get out of your house will be 10% of the house value. So it just won't really look attractive to, if rates are so high, the amount you'll borrow will be so small as to make it almost sort of moot, and so, but as long as the rising rates are sort of muted, the thought was it wasn't really going to affect this particular market so much. It definitely affects the securitization side of it all, but the production side of it not so much. You guys agree with that? Or?
Yeah.
Perfect. Seth,
Yeah,
final words?
I think it's going to be interesting, as G was saying, to see the non-agency prop loans and people using it more not as a financing of last resort, but as a voluntary decision to retirement planning. So I think that's really interesting. The other thing is that the reverses still have are a little besmirched. From years ago, like as you said, there are many mitigating factors now requiring both spouses to be on the mortgage loan, so grandma's not kicked out on the street. But I think they've made a lot of strides. Unlike residential PACE, which you did have abuses where developers were ripping off grandma and everyone else. But they were a minority of a very small minority, but the regulations came in, I understand, particularly in California, and kind of killed the market. So we haven't seen a ton of residential PACE securitization since then. So it's a little similarity.
Yeah. Terrific. Do we have time for questions?
We're at time, but I think we can go over a little bit, so sure, a couple questions.
Okay, so we're going to put it out to the audience. That ends the discussion portion, at least the panelist discussion portion of today's session. Now we'll put it out to the audience. We can take a question or two from the audience virtually or in person, if anybody has one.
Packaged question. When does the happy hour begin?
As soon as we finish the last question.
I'll ask a question. The COVID and with the mortality related to COVID, is that no impact, or did that impact
Oh, that's a great question.
transactions?
I actually looked at our data and it did not greatly impact our mortality rate. And I actually asked RMI as well, and they didn't really see a big flip either.
I think anecdotally, with absolutely no data to support this whatsoever, anecdotally, living in a long-term care facility is a maturity event anyway.
Yeah.
So if you had moved to a long-term care facility where there were some outbreaks and were some spikes, you were already in the liquidation process of the loan. So I think that's partially why this hasn't materialized the way that maybe you would have anticipated. But again, no data whatsoever to corroborate that. That is just my thought.
Yeah.
Sign no more.
Yeah.
And actually, we're in the process of cracking all that data from the last year's worth of remits. And so we anticipate that we modified our stresses to anticipate much longer workouts of liquidations, for example. And we also anticipated higher mortality rates, but I'm not entirely sure how strong that's going to be in actual fact. One of the curiosities we had going into the COVID crisis was, are people going to draw on their line of credit much more? So whoops, we're going into crisis, let me pull my line of credit. And that's kind of, maybe you would, maybe that's the end of the world kind of thing, but if you just draw your line of credit, you're also, you're reaccruing your house away from you faster than you would anyway. So there's no real point to just draw just for unless you take the money and put it on the mattress, right? And I think we haven't seen any in the data any accelerated lines of credit draw rates at all. So we entered the COVID crisis. How are people going to react? And the answer really was nothing. They just kept doing what they're doing.
We should have drawn the YOLO GameStop options.
Bridging into equities too. With that, I think that brings us to the end. If there are no other questions, I know we're getting close to cocktail social hour. So on behalf of DBRS Morningstar and my fellow panelists, this concludes our session.